On your screen, you see a graph. It shows the performance of a fund. With a 10,000 rupee SIP, you would have accumulated close to 6 lakhs in just 3 years. That's a return of 34.33% per annum. In 5 years, your corpus would have been rupees 13 lakhs or a gain of 31.83 per annum. During this period, this funds category has delivered returns of 27.71% and 27.19% respectively. Its benchmark is further behind at 22.76% and 22.54%. The fund's performance may impress you, but wait, there is more. The AUM of this fund is a mammoth 32,000 crore as of June 2023. And guess what? It's a small cap fund. By now, many of you would have guessed this fund's name. If not, well, the fund name is Nippon India Small Cap Fund. Managing such large AUM is challenging for even diversified equity funds. Still, this small cap fund has not only done that, but also delivered good outperformance over the category and the benchmark. But how did it do so? More importantly, can it continue to do well as its AUM grows further? In this video, we will find answers to these questions as we decode Nippon India Small Cap Fund. But before we begin, a quick reminder. Do subscribe to our channel and don't forget to press the bell icon so you never miss a video from us. Alright, let's begin. This video is divided into two sections. Number 1, we will discuss how this fund is managed, or how has the fund manager delivered outperformance over the category and the benchmark despite its ever-increasing size. In the second part, we will look at can it continue to do well amid its growing size. If you are wondering why size could be a problem, we will answer that too. So first, let's see how this fund is managed. Now, in an interview with Morningstar in November 2022, Nippon India Small Cap's fund manager Samir Rachh revealed the fund strategy. And the one thing that works for the fund is diversification, he said. Let's first look at the 5 points he made. After that, we will look at the data to go deeper into the fund strategy. Now, Rachh said that when it comes to small caps, diversification works beautifully. Because of diversification, he can hold stocks for a longer time. This allows the fund manager to ride the winners and take care of the interim volatility. The stable performance from some and the outperformance from others balance the underperformance of certain stocks. The fund invests only up to 4% in a single stock. The moment a stock crosses more than 5%, he starts trimming it out. So all in all, Nippon India Small Cap strategy lies in ample diversification and the virtues that it brings, such as lower volatility, better risk control, and so on. Now, we decided to look deeper into Nippon India Small Cap Fund to see if the fund indeed exhibits what the fund manager is trying to do. So let's start with the number and concentration of stocks in the fund's portfolio. The fund manager said that he likes to have a well-diversified portfolio with no more than 4% allocated to a single stock. What does the data suggest? Let's take a look. As the AUM went up, the number of stocks also increased. The fund held 117 stocks in June 2019 and it now holds 180 stocks. This is unusual and rare in the Indian mutual fund space. Other small cap funds don't invest in as many stocks. Now let's compare the number of stocks in Nippon India Small Cap Fund's portfolio to the category average. While this fund holds 180 stocks at present, the category average is just 72 stocks. The second largest fund in the category is HDFC Small Cap Fund with almost 19,000 crore worth of assets under management, and it has just 71 stocks in its portfolio. So this means Nippon India Small Cap Fund is highly diversified. But is it? Before you make up your mind, let's check the fund's stock concentration by the quartile. See the table on your screen. Now, if you're not sure about what a quartile is, let us explain. The quartile means 25%. So when we divide something into quartiles, we get 4 parts of 25% each. Now in this table, we have divided the fund's portfolio across quartiles. We first sorted the fund's holdings by the percentage of assets deployed in them. Then we saw how many stocks it took to make the first 25% or the first quartile, the next 25%, and so on. For instance, in 2023, it took 17 stocks to reach the first 25% of assets, 27 stocks to reach the next, 41 stocks to complete the third quartile, and 98 stocks for the last quartile. To put it simply, 25% of the fund's AUM is in 17 stocks. the next 25% in 27 stocks, and so on. Now, how does quartile analysis help? It helps us understand which part of the portfolio is the most crowded. We can see that the fund has fewer stocks in the top 25%. Now, between 2019 and 2023, this number ranged from 9 to 17. The number of stocks in the bottom quartile, that is quartile fourth, is quite high. Between 2019 and 2023, this number ranged from 57 to 98. Now, if we add the number of stocks in the top 3 quartile, this number has ranged from 53 to 85 stocks between 2019 and 2023. Now, what does this imply? While the fund does spread its assets across a large number of stocks, it's significantly more concentrated on its top bets. This helps the fund's top bets drive the portfolio performance. This can probably be the reason for the fund's outperformance despite a large number of stocks. A significant number of stocks in its portfolio belong to quartile 4 and have minuscule allocation of 0.23% to 0.41% over the years. So when we see a large number of stocks, we actually see the tail of this fund. The fund is not as diversified as you may want to believe. Now, it's also apparent that to take exposure to so many stocks, the fund will have to step out of its benchmark, the Nifty Small Cap 250 index. But how much? The table shows that the fund does go beyond the stocks that are part of the Nifty Small Cap 250 index by a great extent. As much as 43% of its AUM was invested in stocks that are not part of the index as of June end 2023. Now, going beyond its benchmark index may have also helped it deliver outperformance over the index, as it's likely that the fund ventures into the so-called microcaps. Now, microcaps are stocks that are beyond the top 500 stocks in terms of market cap. These stocks tend to have a higher risk-reward ratio, so they could have contributed to the fund's returns. Alright, another thing that the fund manager said is that diversifying well helps him stay invested for the long term. Let's check that aspect as well. Now, we looked at the fund's June end portfolio from 2018 to 2023 to find out if any stock has stayed in the portfolio for the last 5 years. Now, as you can see in the table on your screen, as many as 47 stocks have remained constant in the fund's June end portfolios between 2018 and 2023. This is indeed a testament to the fund's manager's philosophy. On average, these stocks have delivered an annualized return of 19%, which suggests that these bets have worked as well. Now, generally, small cap funds do take long-term bets as it's not easy to build positions and exit small cap stocks. So, staying invested for the long term is important. This fund appears to be doing it well. We will talk about why it may be difficult for small cap funds to build and exit positions in detail a bit later in the video. Okay, this was about the concentration of stocks in Nippon India Small Cap Fund. Let's now see the sectoral concentration. Does this fund take concentrated calls on sectors, or does it spread its assets far and wide? The chart on your screen gives the answer. The fund's allocation to the top 5 sectors is considerably higher than the category allocation. It has ranged from 41% to 49% between 2019 and 2023, as against the category's 36% to 42%. Now, this indicates that the fund's sectoral conviction may have also played a role in its outperformance. It doesn't spread its assets across sectors, but is mindful of its sectoral allocation. Now, having seen the fund's sectoral allocation, let's now assess how successful it has been when it comes to controlling volatility and delivering risk-adjusted returns. Now, to check volatility, we use a parameter called standard deviation. The higher the standard deviation, the more volatile a fund is. As seen in the chart, the fund is actually more volatile than the category and the benchmark. But volatility could be both good and bad. Good volatility is when the prices suddenly go up. Bad volatility is when they suddenly fall. So how well has the fund controlled its bad volatility and thus delivered better risk-adjusted returns? To measure that, we use a parameter called the Sortino ratio. The higher the Sortino ratio, the less is the fund's downside volatility. As you can see, the fund has decent record of delivering risk-adjusted returns. It did better than the category and the benchmark in 2022 and 2023. In 2020, it did better than the category, and in 2021, it did better than the benchmark. Alright, before we go further, let's quickly summarize the key points. Number 1. The fund does buy more stocks than the category average, and the number of stocks have gone up with AUM. But this is not to say the assets are evenly distributed. Number 2, its 75% assets have been invested in 53 to 85 stocks, which has probably helped the fund deliver outperformance. Number 3, the fund doesn't mind going beyond the benchmark index and has a sizable corpus in stocks outside the index. This stock selection could have also contributed to its outperformance. Number 4, it does hold on to stocks for the long run. As many as 47 stocks in its current portfolio have been there since 2018. Number 5, the fund takes a more concentrated bet on sectors as compared to the category. Its sectoral calls are thus a contributor to its outperformance. Number 6, it can be more volatile than the category and the benchmark, but has managed to do well in terms of delivering risk-adjusted performance. So this is how the fund has been managed so far. And now it's time to take on the elephant in the room. That is this fund size. Can it be a problem? And why should it be a problem? Let's see. Now the fund's AUM has risen from around 8,200 crores in June 2019 to 31,000 crores in June 2023. That's a growth of 4 times in 4 years. Now can this massive size be a problem? But if you are wondering how size could be a problem, let us explain. Small cap funds must invest at least 65% of their assets in small cap stocks. Now small cap companies have comparatively low sizes, so it could be difficult for the fund to deploy their assets. For example, if Nippon India Small Cap Fund wants to deploy just 1% of its assets in a small cap company, the amount would be about 319 crores. Now, if the target small cap company has a market cap of 3,000 crores, this amount is more than 10% of the company's market cap. It's difficult to find that much liquidity at a point in time, meaning the number of stocks required may simply not be up for sale. For a small cap stock that has a market cap of 6,000 crore, the amount is still more than 5% of the company's market cap. So first, it's difficult to get so much liquidity to acquire these many stocks, and second, such a large order can result in a jump in the stock price as a large amount is chasing a limited quantity of stock. So the fund will probably not be able to buy the stock at its desired price. Rather, it may have to end up paying more. This phenomenon is called the impact cost in the stock market. For these reasons, a large sized small cap fund will increasingly find it difficult to deploy its corpus as it can't keep increasing allocation to stocks already in the portfolio. And also, it will be difficult to sell as there might not be enough buyers. Eventually, it may also have to move more and more of its corpus to mid and large caps, of course subject to the upper limit of 35%. All these factors can impact its returns. This is the winner's curse in small cap funds. Now, can such a thing happen with Nippon India Small Cap Fund too? Well, this can't be ruled out, but so far, size has not been a hindrance for the performance of larger small cap funds. See the table on your screen. It compares the ranks in terms of returns of top 3 and the bottom 3 small cap funds by AUM that have history of at least 6 years. We can see from the table that being small in size doesn't automatically mean outperformance. The smallest funds by AUM have had ranks above 10 on 8 occasions. Being big in size hasn't been a handicap so far. The largest funds have exhibited ranks above 10 in just 6 cases. But this is not to rule out the challenges of size of small cap funds. That's one of the reasons why Nippon India Small Cap Fund has restricted its inflows. You cannot invest lump sums in it now, but SIPs up to 5 lakh per day per PAN are still possible in the fund. Also, the allocation to large cap stocks in the fund's portfolio has risen from 7% in June 2021 to 15% in June 2023. This could also be due to the challenge of deploying a rising AUM. As of June 2023, Nippon India Small Cap Fund has the second largest allocation to large caps within the category. Now, since large caps tend to have a lower return profile, a significant jump in large caps in the portfolio can pull down the fund's returns. But of course, they can also lend more stability to the fund as well. So while Nippon India Small Cap Fund has done well in the past despite its size, it remains to be seen how it does in the future. So far, its high conviction bets and diversified into as many as 180 stocks have paid off. Now we have tried to provide you with the necessary data so you can decide whether you should invest in this fund or what to do with your existing investments. I hope you found it useful. With this, we have come to the end of the video. If you like the video, do share it with your friends and family, and we will see you again soon with a new video. Until then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.